Hey everybody, we're back again today to talk about charitable giving using life insurance. This is a very powerful strategy that has been gaining a lot of momentum in the industry. We've actually got some advisors that make this a primary or even the sole focus of their practice and have been doing really well with it. With that being said, we're here today for a lot of the advisors that I talk to that don't necessarily want to make it the sole focus of their practice, but they really do want to know more about it and be able to add it as a piece of all the things that they do. And so we're going to take a look at some examples and some case studies around some simple ways that insurance can be really beneficial to you and your clients in terms of both the good that they can do and the impact that they can have and causes that are near and dear to their heart, and also the impact that it can have on their tax and estate planning. So let's take a look at the first of these simple options, which is donating the proceeds of an insurance policy, making the charity or cause of your choice the beneficiary of a policy so that they receive those death benefit proceeds when the client is to pass away. So let's meet our first couple. We've got John and Cindy. Right, they're in their mid 50s. They live in Ontario. They're doing quite well for themselves. They've got a combined income of about 250 grand. And most importantly, they have a cottage. Why is this important? It's important because when they are to pass away, they want that cottage to go to their kids. And what's in the way between them and giving that cottage to their kids? The CRA. The CRA is going to have their hand out and want a big old chunk in terms of capital gains tax. That can be a bit of a problem. So we've done some calculations here. It's over $400,000 are going to be owed. That's not chump change to have lying around liquid in your estate to be able to pay the CRA. So what are their other options, right? Besides waiting and hoping that that money's there. Well, they could take that same money and put it into an insurance policy over the course of the next 20 years. And so same amount of money deployed as they would if they just paid off that tax bill. But what are the differences, both in terms of the impact that it has on the charity and the impact that it has on their terminal tax bill and their estate? So first, the impact on the charity. If they were to just donate that money, the charity gets about $400,000. If they put it into insurance, that same charity got almost $2 million in benefit. That is a massive multiplier in terms of the good that was done with that money, right? In terms of tax credits, if they paid the bill or their estate paid the bill, great, that's gone. That's $400,000 that goes to their estate. If they donated that money, they get just under 200 grand worth of tax credits. But if they put that money into an insurance policy, not only have they covered off the liability for the cottage, but they've also got over $300,000 of other tax credits to help their estate and make sure that the kids are getting as much as they possibly can. So this is a pretty simple illustration of the power, both from a tax perspective and a giving perspective, that insurance can play as a force multiplier in these kinds of scenarios. And so this idea of donating the proceeds of the policy, it's very beneficial in terms of that tax credit to your estate. Very important that if clients are doing this, they get to maintain ownership and control. They can change their minds if they want to. That control is often really important, and confidentiality. Right, that donation can be made out of prying eyes, whether they want it to be anonymous or not. It can be kept out of the public gaze. The cons or the drawbacks, well, both the tax benefit and the benefit of the charity don't happen until after the clients have passed away. So they don't get to see the benefits of their proper planning, but they do get to pass on knowing that they left a great legacy. Now, not everybody wants to wait until they passed away for some of these benefits to happen. And so the other often used scenario is, instead of donating the proceeds, it's donating the policy itself and then continuing to pay those premiums. And this gives the clients a tax credit every year, so they get to see that benefit while they're still alive. So for that, we're going to meet Greg. Greg is a little bit of a different circumstance. He's a little bit older. He's nearing 70. he is very wealthy. He does very well for himself. He's maxed out his RRSPs and his TFSAs. He's been saving like a madman. And so now in retirement, um, he he's being forced to take a lot more money than he really needs to, or than he needs to pay his bills. And so he's paying a lot more tax than he'd like to in retirement. And he's also really gotten engaged in trying to donate to a cause that's near and dear to him. I've used the Hamilton Health Sciences Foundation because it's near and dear to me, but it doesn't really matter. It can be any cause or charity that is at the heart of the client. And so, what is he to do? Right? Well, he wants to try and minimize those taxes. He wants to support a cause, and he wants to do that as efficiently as possible. And so, again, he could just donate the cash, or he could do it using insurance. And so, if he wanted to buy a new policy and pay those premiums of 50 grand a year, and donate that policy right away to the charity, what's that going to look like? Again, both in terms of the good done for the charity and the tax benefits to him. Well, uh, as you might expect, again, the benefit to the charity using insurance is multiplied. It goes from about 900 grand to over 1.5 million. Now, the tax credits back to him are the same, but if he was going to pay that money one way or the other to alleviate that tax burden, he might as well do it in a way that's also going to benefit that charity that's near and dear to his heart as much as possible. So a little bit different. Both have their benefits and their drawbacks, but when donating the policy, you get that annual tax credit. So you get to see that benefit while you're still alive. You still get to leave a larger legacy to the charity, and you get to keep that confidentiality. Some of the drawbacks are it can be a lot more complicated, and you have to assign the policy to that charity, which means they get to keep control over it. They essentially own it at that point, which means you can't change your mind and you don't necessarily have the control or being able to use some of that cash value in the meantime. And it still creates a delayed benefit to the charity, and you don't get any of that tax relief on death. Now, there's not one way is not better or worse. They are different and they work differently for different clients in different circumstances. So the real power is being able to have this conversation with your clients and try to figure out what they're really trying to accomplish. Now, those are two of the simplest ways that this can be done, but we can add in some other layers that might have some other benefits as well. Not everybody wants to have these continuous streams of premiums that they have to pay one way or the other, whether they've donated the policy or the proceeds. So maybe they just want to give a chunk of money away and say, all right, I've done my good deed and want the same benefits. Well, there are new products that allow for this, including Canada Life's My Par Gift, or you could even buy an annuity that then pays those future premiums, but just takes that one lump sum from the client. It also doesn't even have to be a new policy. A lot of this donating of policies gets done with existing policies that are no longer needed, whether it's a term policy that's expiring and isn't really necessary anymore, or whether it's even a paid up whole life policy that just is adding more than that person needs for their estate planning. The key point that we want to get across that using insurance for charitable giving doesn't need to be overwhelming. It doesn't need to be intimidating. And hopefully this was a great start that can really help you get to that point of feeling comfortable with it and adding it to your practice.